My name's Omar Negyal. I'm a portfolio manager at JPMorgan. I manage the JPMorgan Global Emerging Markets Income Trust. I've been at JPMorgan for the last 10 years managing income strategies on the emerging markets and Asia Pacific team. The trust began in 2010. The aim of the trust is to deliver an attractive level of income to shareholders and also be able to participate in the growth rate of emerging markets. We only invest in dividend-paying stocks across global emerging markets, and we look to build a portfolio that has a higher dividend yield than the broader market. We can find attractive stocks for dividends across the asset class, so multiple different countries and different sectors. And the good thing about that is it means we're not restricted to one narrow area to provide those dividends and provide the yield for shareholders. We think a dividend approach can be a powerful way to invest in emerging markets. We often describe it as a combination of value and quality. Value, because we're thinking very carefully about the valuations of the stocks that we're investing in, particularly the dividend yields, and we're looking to build that portfolio that has a higher dividend yield than the broader market. So that's the value side. But quality, that comes through in terms of stock selection. So not just thinking about the dividend yield, but the long-term resilience of that dividend and the growth potential of the dividend. So combining that together provides to us an attractive combination of value and quality. One additional point which I think is really important, particularly in emerging markets, is the link that we make between dividend payout and corporate governance. Very simply, if we can find companies that look to reward minority shareholders consistently with cash dividends, to us that's a powerful signal of positive corporate governance. And it's a way of finding the right companies to invest in emerging markets. To develop conviction in our stocks, it's all about understanding the businesses that we're investing in. We're very fortunate as portfolio managers to be supported by a very strong team of analysts at JPMorgan based across the world researching these companies. Our clear, disciplined process within the income trust helps us to identify the right stocks for income. And we can distill that down into three key areas that we're always thinking about: profitability, cash flow, and dividend policy. Firstly, profitability. We're thinking about companies. We want to find companies that generate a high level of earnings that can support the dividend payments every year. Then cash flows. Clearly, companies can't afford to pay dividends in the long term if they don't generate cash. So that's again something we want to understand. And then finally, dividend policy. Thinking about that governance point, are management teams actually willing to return cash to shareholders year in, year out? Combining that together, that's how we develop conviction in the stocks that we hold in the portfolio. One positive example of an income stock in the portfolio is a company called Taiwan Semiconductor, TSMC. This is a company that is an outsourced semiconductor chip manufacturer. So any company around the world that's designing chips and wants to outsource the production of those, they might go to a company like TSMC, which has a very strong market share, a very good competitive advantage in this industry. And that helps it to generate a high level of profitability and produce those cash flows that are really important to support dividends. And finally, when we look at the track record of this company, we see that the management team has delivered a stable, growing level of dividends over time. So that combination of profitability, cash flow, and dividend policy is a really nice example for that company in terms of making it positive for the portfolio. key starting point for the portfolio are the individual stocks that we choose from a dividend perspective. That does lead us to have particular tilts in the portfolio from a country perspective or a sector perspective. And we'll look to manage that on an active basis, thinking about the risks, whether it's from a specific country or a particular sector. For example, the financials tilt, how much consumer staples exposure we have, or the weight of the technology space within the portfolio. One other area to consider is the importance of currency. For example, the US dollar has seen strength over the last few years, and that's been a headwind in general for emerging markets. And again, something that we'd want to think about when we think about the overall portfolio construction. And finally, we're very aware that we're receiving in dividends from many different markets in different currencies and paying out those dividends to shareholders in sterling. So again, managing our way through the year-by-year volatility in those currencies is something that we want to consider very carefully. Emerging markets still has a lot to offer to investors. This is an area comprising a meaningful percentage of the global population, which in the long term still has growth potential. And that's something that equity investors can look to take advantage of. And from an income perspective, we're looking at dividends being paid each year to provide an income stream while participating in that long-term potential growth. Investors often don't immediately make the connection between income and emerging markets. But if we look over time, emerging markets over many years has delivered a remarkably consistent dividend payout ratio. And that means that any income-seeking investor should think about emerging markets as part of their portfolio. In addition, the positive aspect of dividend investing, that combination of value and quality, make an income approach in emerging markets potentially an attractive one. And that's something that we seek to capture in terms of our approach for the Income Trust.